Today we're going to look at indirect taxation, and I'm going to start with the definition. Now basically, what does it mean? Well, indirect tax is a tax on goods and services. It's usually imposed directly on firms, who then normally pass on a proportion or the whole or some of the tax onto consumers. So it also has an impact on the level of consumption, and we'll see this later. If we first then have a look at this diagram, this is a typical diagram you're going to come across when looking at indirect taxation. Firstly, if we have a look at the size of the tax, well, quite clearly the size of the tax is the difference between the two supply curves. Now, why does the supply curve shift? Well, quite simply, the firm's cost of production have risen. Therefore, at each and every price level, they're supplying less at that price. And we can see that here. Also note that the shift of the supply curves is parallel. Now that tells us that it's a specific type of tax. In this case, a unit or specific tax. If it was an ad valorem tax, then that would result in the curves going in a wedge shape like this. But on the OCR specification, it's absolutely fine to just deal with this type of tax. So having a look then, what's happening? Well, we've got this shift from S to S1. So initially, we had an equilibrium, let's call it at A, and now we've moved to an equilibrium, let's call it B. The size of the tax, like I say, is the difference between the two. And if we call this T, we can see here, this difference, vertical difference between the two supply curves, is the size of the tax. What's interesting though is who actually pays this tax. Now, who pays the tax? The key thing to consider here depends on the price elasticity of demand, or the slope of the demand curve. Let's have a look at this example with an inelastic demand curve. Well, as we can see with this inelastic demand curve, if we think of the tax as being T to B, we can find that actually quite a lot of the tax is paid for by the consumer, and we can see that here. The consumer actually pays the difference between the initial price they were paying, which was at this point P, they're now paying a higher price P1. So the consumer is paying this proportion of the tax. If we call this point here, we call that point there F. So the consumer is paying this area P, P1, B, F, all this area in here. Now the producer is also paying some of this tax, but notice it's a much smaller amount, and we can see that here. The producer is only paying ZP, FT, or if I shade it in here, hopefully you can see the difference. Okay, this is the proportion of the tax that the producer is paying. Much smaller than the consumer burden, and that's all to do with the elasticity of demand. What's also interesting is the size of the tax in total. Now the size of the tax in total is quite simply Z, P1, B, T, or both shaded areas combined. Now okay, we've looked at the incidence of the tax, i.e. who pays it. Another name for incidence is burden of tax. We also see there's quite a lot of tax revenue raised here. Remember, that could be useful to the government to be used, for instance, for funding information campaigns if you've got demerit goods, goods associated with negative externalities. What's also significant though, if we see that the demand curve is inelastic, notice on the axis here, if we tax an inelastic good, there is only a marginal fall in the quantity consumed. Now this is very significant. Initially, quantity consumed was OQ, and now it's OQ1. This is a small fall. So actually, has the tax been effective in reducing consumption? Clearly, if the demand for the good is inelastic, we could argue that it's had a very minor impact on consumption. We can contrast this with the diagram we're going to point to you now. Now this is one I prepared earlier. This is looking at a very different demand curve. This demand curve, as you can see, is relatively flat with a typical negative slope. It's an elastic demand curve. But notice how things have changed here. We still have the tax, of course, which is still the vertical distance between the two supply curves. However, notice how the burdens change. The consumer is paying a lot less of the tax this time. This area here, marked with C. Producer is paying a much greater proportion of the tax, this area P. But also significantly, look at the difference in consumption. If you have an elastic demand curve, a tax can be very effective. We can see initially demand was OQ1, now it's OQ. Now the lesson there is that elasticity has a big bearing on the effectiveness of the tax. Basically, the more elastic the demand curve, the more effective indirect taxation will be on reducing consumption of a demerit good.